In mid-2024, small cap funds was the hottest in India. Everyone rushed to invest, seeing the jaw-dropping returns. In less than a year, it has crashed 25%. Investors lost their hard-earned money, and this is not an isolated case. This cycle repeats itself over and over in every small cap rally. And the truth is, small cap mutual funds have a secret pattern that the fund managers know best, but retail investors often overlook this. So in today's video, we will break this down and I will show you why small cap funds skyrocket first and then they collapse, when to invest and when to stay out based on fund managers' own action, a data-backed approach to riding the momentum while avoiding big pitfalls. By the end, you will have a clear strategy for small cap investing so you don't fall into the same trap again. Despite the potential for high returns, I personally choose to invest in small cap funds under a certain market condition and through very specific funds which I will share. Meanwhile, if you enjoy creative content, investing lessons, please consider liking this video. Your support means a lot. It motivates me to do more research and share more. If you are rushing to invest in a small cap fund of your favorite trusted fund manager, and if the small cap is the best way to make money, is your fund manager himself betting big on small cap? And here's how you can check it. The professionals managing thousands of crores perhaps are barely allocating to small caps. If you see, just for an example, I'm choosing an old fund in the category of flexi cap. This is not a recommendation. This is only to illustrate the point that I'm considering these funds. So if you look at the HDFC flexi cap fund, an old fund, the giant and large cap constitutes the maximum. Small cap is just 3%. Nippon flexi cap fund, similar observation. Their allocation to small cap category is only 6%. Forget these two funds. The flexi cap category's average small cap allocation 7%. They are allocating even smaller to small cap now. Remember, in flexi cap fund category, the fund manager has the liberty to allocate to invest across large, mid or small. And if they are keeping the small cap exposure so low, why? Why are they keeping the small cap exposure so low? Well, you might argue that these funds are very large in their asset base. Therefore, it is difficult for them to allocate more into small cap category and hence the lower exposure. But then they also run small cap funds dedicated, and if you see their AUM, they are also fairly large. For example, this fund has 50,000 crores and a large part of it has to compulsorily be in small cap funds. On the other side, let's look at smaller AUM funds such as 1,000 crore funds. Here again, the allocation to small cap is between 4 to 5%. So when the fund manager themselves are not allocating to small cap in their flexi cap category, what gives confidence to retail investors? Is there something that the retail investors know that the fund manager does not? These fund managers have teams of analysts, data-driven strategies, and full-time access into market resources. So if small cap was truly the best bet, then they would be increasing their allocation in their flexi cap funds, because this fund is a category that invests across all the market caps, large, mid and small, based on their outlook. Instead, they are staying cautious. What do they know that retail investors don't? Are small caps more expensive today? Are the risk-reward ratios not favorable? Are they waiting for a better entry point? So to know the right time to enter aggressively into small cap, follow the fund manager's action. When you see flexi cap funds allocating increasing amount into small cap exposure, that's a strong indicator. Now, why small caps are so tempting? Very likely they are the rags to riches dreams of the stock market. Every decade, a few stocks go from being the unknown into turning into a multi-bagger sensation. For example, Infosys in 90s, Bajaj Finance in 2000, Relaxo Footwear in 2010. Who would not want to catch the next big winner? And when you see the past performance charts, when it shows a 30% CAGR over 5 years, the FOMO gets the better of us. But here is one part that we hardly speak about. Small caps don't go up in a straight line. They crash hard every few years. Let's look at the data. Over the past 5 years until 24 December, small caps delivered impressive return. For instance, the category achieved 31% annualized return. It outperformed the large cap funds that returned only 13% during the same period. But after Jan 25, small cap funds have faced downturn with an average loss of about 20%. In 2018 crash, small caps lost 35%. In COVID crash, they lost 45%. 2008, 70%. Small caps rise fastest in a bull market, but when the tide turns, they fall the hardest. Now you might think, so what? I will stay invested for 10 or 15 years. So let us look at long-term numbers. The 15 years rolling return of small cap category, 10.69%. Large cap, 10.85%. Yes, after all the volatility, small caps don't even give significantly higher returns, even if you had held for a very long period. So, if you are not comfortable with extreme swings, why take the unnecessary risk? You cannot overstay in the small cap funds based on these historical data. Of course, no one knows the future, but in the absence of a prediction mechanism, you can learn from the past and prepare for the future. Clearly, small caps, you have to be able to sell to lock in the gains. The challenge though is timing. That is very difficult to sell at the peak because you do not know it is a peak as you go through it. You know it was a peak only because the small caps corrected and crashed significantly. However, small caps an interesting asset class we cannot afford to miss. I have done a very detailed video on why small cap should be part of our portfolio. But this video is about timing, valuation metrics, when to invest aggressively, when to be light. So let us look at the second framework. This is using historical returns as a valuation signal, comparing short-term versus long-term performance. 10-year CAGR of small cap, 14%. This represents the long-term average growth rate. Current 3-year CAGR is 17%, higher than the long-term average. Current 5-year CAGR, 36%, way above historical averages. But this is an isolated case as 5 years back, we were exactly at the COVID bottom. Hence, this is an exception. What does this mean? When short-term returns, that is 3 and 5 year, are much higher than long-term 10 years, small caps are likely in a bull phase and might be expensive. Not the best time to invest aggressively. When short-term returns fall below the long-term returns, it often signals a better valuation and entry point. So here is the actionable plan. 3-year, 5-year CAGR greater than 10-year by a wide margin, avoid lump sum, go slow with SIPs or wait for correction. If 3-year, 5-year is less than 10-year CAGR, valuations may be reasonable, good time to accumulate. Track small cap indices quarterly to see when the short-term returns cool off below the 10-year average. In summary, don't chase small caps when they are soaring. Look for value when short-term returns drop near historical averages. This simple trick can help you avoid buying at the top and invest when small caps offer the best risk reward. These signals are probabilistic and not deterministic. In other words, they indicate a likelihood. These are not guarantees because markets can always behave in an unpredictable manner. So use this as one piece of the puzzle rather than the final verdict. Third is to identify a momentum FOMO framework. The small cap universe has evolved significantly with many new companies getting into this listed space. This makes it a fertile ground for investors to invest, but they can't get the timing wrong. If they are investing at the wrong time, it can be very risky. So avoiding FOMO is a key here. We must also understand the opportunity cost of not investing in small cap. An expensive market can remain expensive for a very long time, driven by liquidity and investor demand. So sitting out completely may lead to regret if the small caps continue to rally. However, chasing momentum blindly can also be dangerous. So the key is to recognize when the momentum is strong and when a correction is likely to occur. If you prefer a momentum-driven approach, one way to gauge the trend is through moving averages. A strong uptrend exists when the price is above 20-day moving average, which is more than 50-day moving average, which is more than 100-day, which is more than 200-day moving average. When it starts dipping below the 20-day and a 50-day moving average, it can signal a potential reversal. And if it continues to break below the longer term moving averages, the momentum weakens further. Conversely, if the small caps have undergone a correction and the price is below all the moving averages in the reverse order, it could indicate a buying opportunity, provided other fundamental and valuation metrics also support the case. So think of the moving average as a traffic light. Green light, price is above all the moving average, bullish trend. Yellow light, price is at the 50-day moving average, could be signs of reversal. Red light, price is below 50-day moving average, high risk of correction. For example, in 2020, small caps broke above the 50-day moving average and market entered into a strong uptrend. In 2018, small caps fell below the 50-day moving average. The bearish phase lasted for about 18 months. Remember, momentum works until it stops working. If the fundamentals don't support a rally, even the technical signals won't save you. So there is a very smart way to participate in these small caps, given the cyclical nature of the small caps. Missing an entry point can be frustrating. Personally, I prefer taking exposure through flexi-cap funds and multi-cap funds where a minimum of 25% is allocated to small cap. This offers a more balanced approach. Beyond that, investors can decide based on the two frameworks we discussed. If you enjoy the content of this video, please consider liking it, sharing it with your friends, and subscribing to this channel.